Park Place Investment welcomes you to another episode of Investment Cubed, where we talk about the world of commercial real estate and real estate financing, Silicon Valley and technology startups, and investment and personal finance.
Hi everyone, welcome back to another episode of Investment Cubed. Today we have two great guests here from Kirkland Capital Group to discuss their real estate debt equity fund. First, we have Brock Freeman, the COO and managing partner of Kirkland Capital Group, a commercial real estate debt fund with consistent equity-like returns and a focus on capital preservation. His career spans technology, finance, and real estate in both Asia and America. He runs the PropTech Seattle open house events and is the Seattle Regional Chair for the Foundation for International Blockchain and Real Estate Expertise. He started his career as a Taiwan stock market analyst in Taipei, later moving back to Seattle and joining a mortgage bank as an underwriter, where he built the industry's first web-based end-to-end loan underwriting, processing, secondary marketing platform. He is a member of the Cascadia Blockchain Council and has testified on behalf of a number of blockchain bills for several Washington State House committees. Next, we have Chris Carsley, the Chief Investment Officer and Managing Partner at Kirkland Capital Group. He brings over 25 years of investment industry expertise, specializing in corporate and venture finance, business valuation, business operations efficiency, regulatory compliance practices, securities research, portfolio management, arbitrage trading, and hedging. Previously, Chris was responsible for the creation of the Business Risk and Operational Due Diligence program as a senior member of the Investment Research and Analysis team at Benchmark Plus Management. Chris is currently a trustee and vice president of the Charles Wright Academy Endowment Committee, serving on the board since March 2017. He co-founded the Northwestern Hedge Fund Society, now the Seattle Alternative Investment Association, in 2004, and is the co-head of the executive board of the Seattle CAIA chapter that launched in 2017. He earned his CFA designation in 1998, Chartered Alternative Investment Analyst in 2011, and holds a BBA from the University of Portland.
I'll go first. My name is Brock Freeman. I'm the Chief Operational Officer for the Kirkland Capital Group. And I have a long background in real estate, mostly on the debt side. I spent years in underwriting, everything from building up underwriting teams, underwriting loans myself, as well as auditing other underwriters. And then on the tech side, building underwriting systems or loan processing and underwriting systems as well. This was early on in the residential mortgage space, and then later on now in the commercial space. But that's my specialty, is really understanding what drives risk and how to understand underwriting and doing due diligence around both the loan, the property, as well as the borrowers for a real estate loan.
Hi, I'm Chris Carsley. I'm the Chief Investment Officer for Kirkland Capital Group. Most of my background within real estate all came and was originated on the investment side. I was manager for a number of different accounts that had real estate exposures, specifically on the private side. So I dealt a lot with walking those investors through that investment and also understanding the valuation metrics behind those investments. And then obviously, on a personal basis, having been, directly involved with some equity investments in the real estate space, and now heavily involved on the debt space in the microbalance commercial real estate.
Yeah. So a couple of years ago, as I was looking out into the real estate space once again, after taking a turn for several years in corporate IT, working for some of the largest Fortune 1000 companies, I wanted to come back into real estate. And one of the opportunities that came up was in the space of commercial, I would say, micro balance loans. These are loans under $1 million. And of course, no one just starts up a fund out of nothing. I explored it, and then one of the best people I knew that had such a long period of experience in fund management was one of my friends, Chris. And so I went to talk to him about that, and we started really examining whether this was something that had the really the depth of opportunity, not just to make something that would be a flash in the pan, but something that we could really build a very strong, risk-averse fund around that could serve both investors and borrowers alike with something that we could put together. And I know one of the things that I had in talking with Chris over the years is that with his experience as a fund manager, he had been approached many, many times with building all kinds of different funds. So one of the things I knew was that if I came to him with this idea, that he wouldn't simply just let us go willy-nilly on something, but he would really cause us to do the due diligence. But I know, Chris, one of the things that you had told me in the past was in making those decisions around what to accept or what not to accept in building the funds, you would really started to narrow that down very heavily. But maybe you can talk about one of the reasons that you thought this was a good opportunity in this micro balance commercial loan space.
Yeah, no, I remember the day Brock said, "Hey, I have an idea. We can build a fund around investing in microbalance commercial real estate bridge financing." And I was like, "Okay, give me the rundown. I have a knowledge base of what you're talking about. Why now?" And it was kind of a loaded question. You'll find that I often ask questions where I kind of already know the answer to them. Being in the investment space and following up on research. And hearing the demands from a number of different mind networks in the RIA and wealth manager space was the constant demand for yield. I mean, long before COVID actually occurred and drove us into 150-year lows of on the interest rate scales. We were already at low interest rates. You already had a number of investors, a lot of retirees that were wondering, well, where am I going to capture yield and have it in a risk-adjusted space? And by looking at the nature of where you could come in and capture an excess return on versus comparative investments, and really still have the risk controls in place around being first lien full recourse against an income producing property, resonated heavily, where it put me mentally in a place where I enjoyed, where this is where we want to be on the risk curve, and the returns are extremely competitive across a number of different profiles. And so it really puts you in competition with and able to consistently beat a number of different investments, both traditional and alternative on the investment side. So that was a huge component of coming in and being able to create this and build this fund, and then having a relatively small team giving me the capability to deploy knowledge of a number of different funds that I'd built: seed angel, venture, managed futures, a long short equity fund. Being able to take sort of the best of having built a number of those types of funds and deploy that here was going to move us quickly to where we were really truly going to have quote institutional level operations, regulatory capability, and compliance in place regardless of size. And it also allowed us to the real estate is very different than some of the esoteric trades that were a little bit more black box that I had been exposed to. I liked the idea of being able to approach investors for this fund and really be able to offer them full transparency, which is important in today's world. And I think it's important for investors to want as much transparency as they can possibly get, because that's what I always want. And so there's just a number of factors, not only on the investment side, but on the operational build out side of what Kirkland Income Fund has become. Was a combination of driving forces that led us to be where we are today. So your question is, what's the real objective of the fund? And the way I like to really go into that is where we formed sort of our mission statement of why we were creating this fund. And there's no better way to put it than just to simply read through it. Is delivering an opportunity to invest in micro-balance commercial real estate bridge financing that provides consistent returns through scalable cash flows at lower risk levels to investors, while offering a superior platform for select commercial real estate buyers to source funding. And the reason that became our mission was there's two folds to this fund, where we wanted to not only bring a great investment to investors that are going to allow them to capture consistent yield while controlling risk. We also understand that those trades, as I say, come from a number of different networks that Brock already had many of them, and we continue to develop them. We need to be able to be a platform that's going to have them in mind as well, because that's going to really help build that consistent deal flow from those brokers and those, and other people looking to go out and purchase, commercial real estate.
We are very niche in the type of loans that we do. We've chosen that due to research that we did at the very onset of establishing where the opportunity in the market was. Due to some interesting things that happened post '08, there's not a lot of banks that can participate in the type of debt, particularly bridge debt or short-term debt, the 12 to 24-month debt that now we've seen the rise of a lot of private debt providers be able to offer. So we've seen that huge growth. Now within that, of course, everybody wants to do the huge deal. Everybody wants the 20, 30, 40 million or higher deal and deploy that much capital, make a whole bunch of money on one deal. The challenge is that everybody's doing that. What we wanted to do, and particularly in leveraging a couple of things that we saw were opportunities for us in particular. I have a background in finance, yet a lot of that finance was taken in the area of automation, IT or computer automation, using systems to automate things and lower costs. I first did that in residential mortgage, building some of the first systems out there for the underwriting, processing, and secondary marketing of those mortgage loans. And so I don't see that there's any difference in really being able to apply that to this, what we call micro balance space. That is loans for commercial property or multifamily 5-unit and above that are under $1 million. The reason that we can apply some of that technology and systems here is because there's a huge amount of opportunity out there with in the number of loans that are in property that fall into that space. And because there's not a lot of other bridge lenders that are offering that, because it takes a lot of work still to do that due diligence, a lot of them don't have that informational technology background. They don't have that tech background in order to really lower their cost of doing the due diligence on each one. So by doing larger loans, they kind of sort of do an end run around having a need for that technology. Whereas what we've chosen to do is deploy technology from the very beginning in order to keep our costs low. Now that does a couple of things. First of all, it allows us to capture an outsized return. Our loans are typically in the 11s to 12s, once in a while on 13s that we're able to get. What that means and Chris will talk about this a little bit more in a bit around how we structure a fund, but net, that really gives a return, 8.5 to 9.5% target of returns, net returns to our investors. That's really difficult when you start talking about the larger deals because there's so much more competition. But in order to do that, to make that run well, we had to apply technology, which is what we've done. And that's why, for me, having that background and being able to automate those systems that we have for the due diligence and informational was super important in doing that. The other part is I've built up a couple of times in my career networks of loan brokers. So we've done the same thing here again. We go out, there's a lot of very good loan brokers out there that operate in the commercial loan space. We reach out, we let them know about what kind of program we have here, and there's a lot of deal flow out there. And that really brings me to the second part of it, is what of our investment screening process or due diligence looks like. Because of the number of loans out there in this space, and because there's not a lot of other lenders, we can really pick the cream of the crop. We probably only choose around 10% or maybe even less of the loans that come across our desk, so to say. Do we even start looking at those and end up funding those? We look at a ton of stuff, but we turn down a lot because we don't need to. We don't feel like we're in a position that we have to deploy capital for these type of loans, because there's a scarcity of trade deals. No, the thing is that there's a ton of them out there, so we can pick up the cream. We can really pick up the ones that are not high risk and deploy our capital and our investor capitals and our own capital into those trade deals. On top of that, because of the fact that they're smaller deals, we can spread our investment capital among more of them. That means that if any one of them has an issue, that means we're putting less of our entire portfolio at risk. We can also apply a lot of both internal or paid for information that we get from data points that we get from both private and public sources, and use that to make determinations. That gets us away from what happens with a lot of private large debt, is the more anecdotal, I need boots on the ground to really understand, does this look good or not? But then you run against human biases. We've tried to really, along with automation, eliminate that sort of human bias by using both public and private data sources to do our due diligence as well. And I think then we also take and roll that up, and then Chris takes a look at it from across the portfolio on whether we should deploy capital in certain places, and so that we don't get too much concentration. So Chris, you might want to talk a little bit about that sort of due diligence, that extra level of due diligence we do, not just on an individual deal, but how do we look at that across the portfolio?
Yeah, no, definitely. When we're filtering through, one of the aspects of building out the portfolio is to understand dollar allocation to a loan. We do see a lot of loans that come in that are millions of dollars, which would be a concentration in our portfolio. It may be a great investment from first glance, but from a concentration standpoint, wouldn't be an intelligent way to build a portfolio. But there again, we look at, we always started this fund and we thought, hey, we're going to obviously work across a lot of different subsectors within commercial real estate. With COVID, most of our portfolio became, concentrated in multifamily. We didn't really view that as a risk. We viewed that as a risk mitigant given the current environment and the uncertainties around retail and office. Now, I'm not saying those are bad trades, and I'm not saying that in the future we may not have some of those in the portfolio. I'm just saying, right now, that's one of the things that we did in structuring the portfolio, is to really focus on and really capture those income-producing multifamily properties. And although they have their own fears around rent collections and eviction moratoriums, there again, we restructured the portfolio and added factors into our due diligence and requirements of us, our underwriting requirements. One of the things that we added was the ability to obtain prepaid interest payments. So when we write a loan, to help mitigate some of that risk around, are these people going to collect rents and then be able to make interest payments to us? Well, let's give ourselves a window to where that's not an immediate concern. So a lot of the borrowers were totally okay with moving forward and saying, well, hey, I'm going to prepay, 3 to 6 months of interest. And that allowed us to give us a window to watch them perform, deploy out on their business plan, the betterments of the property that they had planned, to get us to the point where, we're going to be in the right place for conventional conversion. But we also look nationwide. We want to develop a portfolio that is not going to have some idiosyncratic event to a certain geographical area, for some reason, has a tornado or has a flood or something like that. And all of a sudden our entire portfolio takes not one, but multiple hits. We want to be in a variety of areas that capture different socioeconomic impacts, different employment impacts, has different exposure to different companies that are helping build those geographical areas, and they need, housing. Those are all the things that we consider when saying, okay, we might have a couple different loans that pass all initial filters. Well, how does it really impact, and what's the value add to the diversification of the portfolio? The way we built this fund out, our expected returns are really arranged because there is a number of factors that's going to create a dynamic impacts of the movements of rates. Some of it may be that the loan is a little bit more risky, so we might capture a higher return. Some that we assess might justify a lower gross yield on a loan. But for the most part, right now, we're seeing everything that we're writing into the 11 to 12% gross on the paper. And we think that will continue for some time. We're looking at record year lows, but you're also looking at a current monetary regime, i.e. our government. They need to keep money cheap. So we don't see that changing. And if it does change, it'll be gradual and something that we will be able to adjust to. But like Brock said earlier, there's a supply and demand factor of why we want to stay in this micro balance space, is it really gives us the ability to capture an inefficiency and of pricing power. We don't have a lot of competition in the loans that are shown to us. Now, with regards to the way we built this for investors, we always want to believe in being very investor focused. And one of those aspects is aligning fees to the nature of what's capable of how we need to run a successful manager. One of the things, the manager is a business, and that manager oversees the fund. So we have to make sure that the manager can actually run effectively so it can continue to manage the fund in proper way. And one of the things that I realized in my early days of building out a number of different funds, I was only able to take fees from investors. So that implied management fees, incentives, and carries in a variety of other factors that you'll see in traditional hedge funds and venture. And what real estate allowed me to really look at and better align with investors is there's inherent fees that are taken in the process of origination of loans. 1.5%, 2%, 3% in origination. There's servicing fees. There's a variety of different things that are inherent in this industry. And that allowed us to really look at Kirkland Capital Group and understand, is there a way for us to better align? And what we found was yes. We were able to come in and not have multi-layers of fees. We charge 1.5% flat. It's an annual management fee that's taken monthly from the investors. The investor also, one of the things that I love that most people don't talk about is fund expenses. Every investor really should go out and really understand what fund expenses are. We actually make it a line item in our statements so that we want our investors to understand everything that impacts them and everything that impacts their return. Fund expenses are extremely minimal, as they should be, and it should be defined in the documents what those are. But I get the question a lot, why don't we have an incentive fee? And I was like, well, I don't need to take extra fees from the investors. The inherent nature of what fees we can take from the borrowers, that origination and other underwriting fees, those numbers combined allow us to really look at, and we built out the pro forma for Kirkland Capital Group to really understand that we can build a sustainable business with those two fee levels. Ideal investor. That's always an interesting question. One of the things of why we decided to put this fund together was it was applicable and appealing to a wide variety of different investors. We would have the investors that need income generation and want monthly payment. We have the individual investors that maybe they don't have exposure to real estate in this fashion, and it would be a great diversifier in their portfolio. We're also looking at we think it would be a good fit for, family offices and a number of other larger investors that might be looking for a part replacement to their fixed income portfolios that aren't generating money right now. We've also got, real estate experts that, they can't find a a deal. They can't find an equity deal to dive into. So they're realizing and saying, well, wow, the returns that you guys are able to capture, and from their standpoint, a purely passive view is not too off what they're seeing in direct equity, and they don't have to come in and replace toilets and do everything else and wake up at 2 a.m. to replace everything. So we actually we've captured a number of different investors that have a good background in real estate and own multiple properties. And they've sort of looked at this as a way to continue. They like the exposure. They don't mind being overweight real estate across their investment portfolio. But this was a differentiated play that, from what they were seeing in today's market, wasn't too different, than the available deals in their geography. So it really is something that if you're investing and you've got a fixed income component to your portfolio, or you've got cash, it's a way to say, wait, I really can capture an amazing risk-adjusted return, which has really allowed us to sit at a lot of tables and have a conversation across a lot of different platforms. That includes RIAs, wealth managers. And yeah, I mean, it's also what we've seen is people deploying non-taxable funds. One of the things that an investor should consider in what we do is, we generate income. It's a short-term income. It's generated monthly, and you should be aware of that and understand how those taxes would impact you. But for investors with self-directed IRAs or rollover IRAs because they left their company and they're busy doing a startup, it's something you should consider, is utilizing those funds and capturing compounding aspects of high single digit to low double digit returns, for your portfolio. So almost anybody, I think there's a fit depending on, what your investment objectives are.
Yeah, I think, to reiterate, Chris said, it's not necessarily that there's people that it doesn't apply to, who doesn't want lower risk, higher return, particularly steady returns that we provide. Perfect place to put in your IRA or your 401k, although we have investors who invest into our fund outside of that. The question is really, how much of your portfolio would you allocate that? We tend to see that as the closer you get to retirement, people tend to want to take less and less risk. And so that's where they tend to expand the amount of money that's in a fund like our Kirkland Income Fund. For the younger set, though, we're starting to see a desire to have a portion of their portfolio in a lower risk, non-correlated investment, such as the Kirkland Income Fund. That gives them a really nice place, an alternative to their stock portfolio or their VC fund that they're investing in, that it's much higher risk.
Yeah, and a lot of the younger investors and older investors, they like the tangibility of real estate. And so this debt fund, if you think about the capital stack of where debt sits, there's a lot of people that like the idea of, I'm going to be a debtor and supported by a tangible asset. That's something that appeals to a lot of